Great. Looks like we've still got a few people trickling in, but we've got a good chunk. So we'll get things started and go from there. So first of all, welcome everyone to today's webinar, which is part of our Young Scholar webinar series on climate change, macroeconomics, and finance that's been organized by the E-Axis Forum. Today, we're going to have Hyeyoon Jung, who's going to present her paper with João Santos and Lee Seltzer on the importance of transition risk, the financial stability by assessing the impact of transition policies on U.S. banks, including those that have joined the Net Zero Banking Alliance. By way of introduction, Hyeyoon is a financial research economist at the Federal Reserve Bank of New York. Her research interests lie in the international finance, financial intermediation, asset pricing, and climate finance areas. Her primary research interests regard understanding the impact of frictions in financial intermediaries on asset prices and real economies. Hyeyoon holds a PhD in finance from NYU Stern and a bachelor's in economics from UPenn Wharton, as well as a BAS from UPenn School of Engineering and Applied Science. So prior to graduate school, she worked as an FX and rates trader at JP Morgan. I personally am a pretty big fan of Hyeyoon's work. Really been some interesting topics and questions that she's been addressing with various co-authors. So I'm very much looking forward to her presentation today. We have some introduction and things in the chat, and we will be posting more information as we go along. If you have questions during the presentation, please feel free to either put them in the chat or in the Q&A, and we will try to either aggregate those as Hyeyoon's going on. She said she's been happy to answer questions, so we'll try and flag the ones that should be talked. If we don't get to those, we'll try and have an abundant amount of time at the end to answer Q&A. I think that is it. I'll be monitoring that. I think that's all I have for introduction. So Hyeyoon, I will turn the time over to you, and we'll have the presentation Q&A for about an hour now. So.
All right, great. Thank you so much for having me. Thank you, Mike, for a very nice introduction. My name is Hyeyoon Jung, and I'm delighted to present my paper, U.S. Banks' Exposure to Climate Transition Risk. This is joint work with João Santos and Lee Seltzer, and we are all at the New York Fed, so the usual disclaimer below applies. So understanding the effects of climate risk on banks is a very important question for researchers, banks, and regulators alike. And in this paper, we focus on climate transition risk. And the transition risk comes from changes in policies as economies move into less carbon-intensive environments. And in this paper, specifically, we ask this question: how much are banks exposed to a specific climate transition policy, such as $50 carbon tax growing at 5% annually? And to answer this question, we develop a measure of banks' credit portfolio exposure to these kinds of transition policies. So before we jump into the model, let me briefly discuss some of the empirical challenges and how we try to address them. So first of all, existing approaches typically rely on backward-looking data, like carbon emissions. And in this paper, we propose a forward-looking measure that quantifies the effect of specific set of climate transition policies on banks. And second, reduced form approaches typically do not capture the general equilibrium effects. And in our approach, we build on estimates from general equilibrium climate models. So our measure is not only forward-looking, but also can capture the direct as well as indirect effects of climate transition policies on banks. And lastly, publicly available credit data are typically based on as of origination, so they may not accurately represent the current exposure if the bank sells the loan after the origination. And to this end, we employ a regulatory granular data set, Y14, that has information on the current loan level credit exposure for large major US banks. And here is our approach in brief. So we are going to take the general equilibrium climate model estimates that answer questions like how much does each industry's output fall if a carbon tax gets introduced and grows at a certain percentage annually. And we employ 3 types of climate models, and each model will provide us this kind of table on the left-hand side. So for each industry, we will have some estimates on changes in either output or profit if a certain carbon tax gets introduced. And we're going to merge this kind of table with Y14 data that has information on banks' credit portfolio. So for each bank, we are going to have the bank's credit portfolio exposure to each industry. So in this stylized example, this bank has 50% of their lending to coal industry and 50% of lending to renewable industry. And by merging these 2 types of data, we can study bank exposure to transition risk across time, across banks, across policies, and we can investigate how banks manage the transition risk over time. So this is our approach in brief. And here are the key findings. First, we find that the bank exposure to transition risk substantially vary across climate models. For instance, the average bank credit exposure as of 2022 ranges between -1% and 9.5%. So -1% means that banks are actually going to be making profits from as the carbon tax introduced. And 9.5% means that banks are going to average bank is going to lose 9.5% of the value of its credit portfolio. And second, across policies, we find that the bank's transition risk exposure is greater for stricter policies. And this is not surprising, but we can quantify the effect. So for instance, relative to a $25 carbon tax, we find that a $50 carbon tax increases the bank exposure by 1%. And third, we also considered a severe scenario considering nonlinear effect. And there we find that the loan portfolio of the average bank can lose up to 11% more than in the baseline scenario. And lastly, we find some evidence that banks appear to reduce the quantity and increase the price of loans made to borrowers in the industries that are highly exposed to the transition risk. So this is evidence supporting that banks are managing pricing and managing the climate risk. So in terms of the contribution to the literature, we add to the literature studying the financial system vulnerability to the climate transition risk by developing exposure measures, capturing general equilibrium effects of carbon policies, and finding that the exposures are manageable. And we also add to the literature studying whether banks and investors price climate transition risk by finding some evidence of banks pricing climate transition risk. And here are the 3 climate models that we are employing. The first one is by Jorgensen and the co-authors, and they provide estimates of changes in industry level output from 2015 to 2050 if a range of carbon tax policies are implemented in 2020. So example is that the initial carbon tax rate is $50 and it grows at 5% annually. And the second model is by Golder and Hofstede, and they also provide the industry level estimates, but they provide the profits instead of output. And their carbon tax policies are slightly different from what Jorgensen et al. Is considering. And the last one is based on the NGFS Network for Greening Financial System. G-cube model, and they provide industry level output changes, but they consider NGFS scenarios, including current, orderly, and disorderly transitions, as opposed to a certain dollar amount of carbon tax policies, like considered in the first two models. So let's get into the model in slightly more detail. So in the first model, Jorgensen model, they provide industry level decline in output for 36 industries, conditional on specific carbon policies. And they consider several initial tax rates of either $25 or $50, growing at either 1% or 5%. And they assume that these taxes are going to be implemented in 2020 and they will grow from 2020 until 2050. And they also model several redistribution of the tax proceeds. The model outputs are produced for the redistribution as a lump sum dividend or a capital tax cut or a labor tax cut. And we find that the redistribution methodology matters for the estimates of our measure. So the earlier slide, I was mentioning that banks can actually benefit from carbon tax policy, and that's when the capital tax cut is used as a redistribution policy. So here is an example of estimate table, and you can see that these columns, these four columns are considering either $25 tax or $50 tax, growing at either 1% or 5% annually. And this is industry by industry. We're gonna have 36 industry for from this model. And I'll show you an example. So for coal mining in this row, you can see that this coal mining industry will lose 16.3% of its output if $25 tax gets introduced, and it grows at 1% annually. So you can see that these estimates are bigger if the initial tax rate is higher and the growth rate is higher. And then the second model is Golden and Halfstead model. And unlike the Jorgensen model, these are based on the percentage changes in the present value of profit rather than the output. And the time horizon is different. They're considering infinite time horizon as opposed to the 2020 to 2050 horizon that the Jorgensen model was considering. And unlike Jorgensen model, this climate model is modeling the renewable sector explicitly, so that we can also estimate the renewable sector specifically. And the last model is by the NGFS G-cube model, and their level industry, the granularity of industry level is slightly coarse. So they're considering 12 industries from 2020 to 2050. And unlike the previous two models, the policy scenarios set a certain carbon tax conditional on achieving a desired policy outcome. So instead of a $50 carbon tax, they're going to consider either the policy is as current or orderly transition, meaning that there are going to be sufficient policies to achieve net zero emissions by 2050, and it's immediately adopted. And this in the disorderly transition, the policy is going to limit the end of century temperature to rise under 2 degrees, adopted in 2031. So the timing and the assumptions on the timing and the policies are slightly different, but each model will provide us with this kind of table so that we can merge with the bank level, bank's credit portfolio exposure to these industries. Let me pause and see if you have any questions so far. Okay, if not, let me move on. So this is how we construct the exposure measure. So the question we ask is, what proportion of each bank's loan portfolio value would be lost if a certain policy P gets implemented? So the exposure measure is constructed by taking the weighted average markdown of the industry, where the weight is the proportion of banks' loan made to the respective industry at time T. And this markdown is the drop in either output or profit of the industry under the specific policy. And these are going to be coming from this kind of table.
Hey, Hyeyoon,
Yeah.
a couple of clarification questions just showed up. If you want to address those in the Q&A, do you want me to give those to you?
Q&A. Yeah, sure. Yeah, I
I
can see.
can read them to you, or do you have them?
Um, yeah, I can see them.
Okay.
So yeah, the first one, can banks react to losses changing their credit allocation? If yes, can these models take into account the effect of changes in the supply of credit? So this is a great question, and I can show you some evidence that banks seem to react to these policies. However, we also find that the bank's exposure to the climate transition policies is very persistent over time. So yes, we find some evidence and that's based on the steady portfolio assumption. And yes, we find some evidence that banks are managing the risk. And the next question, can you explain how a bank would benefit from a carbon tax? So this is also coming in a few slides, but basically the capital tax cut will make the corporates that are highly emitting corporates to be profitable because of the capital tax cut, and then in turn the banks are going to benefit from it. So that's how banks will actually benefit from the carbon tax, and that's why I emphasize that the redistribution policy matters. Okay, and can you explain more about the nonlinearity scenario that's coming? So I will defer that question. And what is the temperature outcome of the current policy in the NGFS model? We are not directly modeling that, but the model, so here, the orderly transition policy is just assuming that sufficient policies are going to be there, and therefore we can achieve the net zero emissions by 2050. And the next question, are you aware of any instances in which research has taken into account cross-sectoral concerns? Insurance, this is great question. I'm not aware of any paper directly modeling these. Even these three climate models are not modeling the financial sector. So, I mean, I would be excited to see such models. But I have a separate paper looking at the insurance company separately. So I would be interested in seeing research combining all of those. Okay, last question. Do you include international trade and capital movements assumptions on foreign policy? Unfortunately not, because we are inheriting the limitations of these climate models. They are not taking into account the different policies across countries. And I'm aware of the research papers showing that banks can actually take arbitrage across countries. They are moving credit from stricter countries to the countries with more relaxed policy. So I'm sure it's important consideration, but we are not able to take those into account. The last question, this is great point. So in these models, the price component is not there. And here we are more, the goal of this paper is to understand the risk exposure of the banks when the policies are already known to the agents. And I have a different paper trying to capture your exact question, the risk effects tied to the unexpected changes in carbon taxes. So I think both approaches are complementary and useful in different by aiming to answer different questions. Okay, so let me move on and I can answer more questions later on. So yes, so this is how we are constructing the exposure measure, going back to these stylized examples where if the coal industry is expected to have 30% decline in output and 20% increase in output for renewable energy, and if the bank is making loans, half of its loans to the coal industry and half of its loans to the renewable industry, and in this case, the exposure measure is going to be simply the average of negative 10%. So it's going to be negative 5%. That's how we are constructing our exposure measure in the baseline. So you can see that we are making two important assumptions. The first is that the banks are going to lose the value of loans proportionally to the drop in the either output or the profit of the borrower's industry. And the second is that the bank maintains their allocation of loans across industries as of time t. So this is static balance sheet assumption, which can be considered strong, and we're gonna but this approach for this approach we are going to have the static balance sheet assumption, and later on we are going to relax the first assumption by considering nonlinearity, potential nonlinear effects. Okay, and this is the average exposure over time. So on the left-hand side, I'm showing you the average exposure based on the Jorgensen's estimates. And on the right-hand side, you're seeing the average exposure based on the NGFS model. And first of all, you can see that the exposure numbers are very different. The maximum average exposure is less than 4% on the left-hand side based on the Jorgensen model. But on the right-hand side, you can see that based on the NGFS model, the maximum average exposure is as high as 13%. So you can see that the exposure measure varies across models and even across policies within the model. So if you look at the left-hand side model, the 4 different lines are based on different tax rate and the growth rate of the tax rate. And if we compare the $25 tax with the $50 tax, the average exposure is different by about 1%. And you can see that as expected, as the initial tax rate goes up and the growth rate goes up, the exposure is going to go up. And lastly, I would like to highlight that across policies, across models, you can see that the exposure measure is quite persistent. However, we are finding that the exposure measure is falling slowly over time, especially if you look at the NGFS model on the right-hand side. And And later on, we are going to show you that the drop in the exposure measure is higher if after the Paris Agreement, and also if the bank signed the net zero alignment, net zero. So before we go there, let me show you our results of the exposure depending on the policy. So here we regress the exposure measure on the policy, the dummy variables on the policies. And this is to examine which policies yield the highest exposure within the same model. And we are controlling for bank level characteristics as well as bank by quarter fixed effects. And we are expecting this beta to be positive if the policy is stricter. And as expected, you can see that the betas are positive. And so the first column, if you look at the first column, that's based on the Jorgensen model. And compared to the $25 tax, the $50 tax increases the exposure by 1%. And in the second column, that's based on the Jorgensen model, but it's looking at the different redistribution policies. And you can see that under the capital income tax cut as a redistribution policy, the exposure is lower. And so the takeaway from this analysis is that stricter policies yield higher exposure, and tax cuts have lower exposures than the lump sum dividends. Okay, and then we consider potential nonlinear effects. So the scenario that we're considering is, what if banks are more severely affected by the riskiest industries based on the model estimates? So here we are calling this exposure under stress. And earlier we were assuming that the bank's loan value will fall proportionally to the drop in the output or the profit at the industry level. But in this case, we are considering that for the riskiest industries, the loan value will be wiped out. So instead of this markdown for the riskiest industries, we are assuming that the markdown is essentially 100%. And to pick the riskiest industries, we focus on either the top decile or the top 2 decile exposed industries as the riskiest industries. So mechanically, we're going to have higher exposure under stress than the exposure measure, the baseline exposure measure. And on the left-hand side, this is based on the Jorgensen's $50 initial tax growing at 5% annually. And the green line is the baseline exposure measure that you saw earlier. And the blue line is when we consider that the top decile industries are going to go bankrupt. And this is about 5% higher than the baseline scenario. And in an even more severe scenario where the top 2 decile industries go bankrupt, we find that the exposure measure goes up additionally by 6%. So in total, the exposure under stress measure is 11% higher than the baseline exposure measure. And on the right-hand side, we did the similar analysis for the NGFS model. And based on this model, we find that the average exposure under stress remains similar to the baseline. And this is because the NGFS scenarios are already very severe. So these are when we consider the potential nonlinear effects. And then we also considered relaxing the first assumption, where the loan value will fall proportionally to the drop in the output or profit. And we did this by using the loss given default and the probability of default at the loan level. So we can compute the expected loss for each loan. And for each industry, we exploit the loan level empirical relationship between the loan losses and the changes in the sales. So earlier we were assuming that the beta was 1. We were considering the 1-to-1 relationship, but in practice, this beta is much lower than 1. So by adjusting the exposure by this empirical relationship, we find that the adjusted exposure measure is much lower. So this blue line is the earlier baseline exposure measure, and after adjusting for the losses, you can see that the adjusted exposure is much lower. It's almost just 1% based on the Jorgensen model. And on the right-hand side, again, the continuous measure, the blue line is the baseline. And you can see that after adjusting, which is the green line, the exposure is only at 3% maximum. So the takeaway here is that adjusting for the loss given default and the probability of default, the exposure measures are even lower. So this gives us a good range of exposures by considering the potential nonlinear effect and also adjusting for the realistic LGD and PD measures. And let me pause here and see what questions I got before I move on. So the first question, your estimation of industry weight in the bank portfolio account downwards for loans that are originated but can be resold later. That's correct. What if we make the hypothesis that they cannot be resold and stay on bank balance sheet? So so this is a great question. So we are sorry, I can see that someone raised hand. Do you want to jump in and ask questions or?
Yeah, I saw a question from Pierre. I don't know if he still wants to answer that directly or.
I can just answer live. So banks, if we make the hypothesis, then they cannot be resold, then I guess the exposure measure is going to be mechanically higher. However, there are papers showing that banks are selling a significant portion of the originated amount after the origination. So I'm not sure what would be realistic assumption to make. But we are using the exposure measure. We are using the bank's loan portfolio holding rather than the origination. So we think that the exposure measure that we are computing is close to what banks are actually holding. I hope that answers your question. I would be happy to discuss more later on. And the next question is, what is the effect of announcing, believing, and knowing the exact policy much earlier than it starts? So yes, this is a great question. And again, we are not able to answer this question without making further assumptions. And for this, I mean, we are gonna have to consider the surprise components, which are not in the model. So again, the other approach, the market-based approach that we are considering in another paper would be more appropriate for answering this question. And the last question, an industry goes bankrupt. So that's obviously a severe scenario. And of course, orderly unwind is more likely. I completely agree. So that's why we are considering these three adjustments. The first one is a very severe scenario here where the industry goes bankrupt, and I agree that it is very unlikely. And the point that we want to make here is that in such a severe and unlikely scenario, the banks are going to lose up to 17% here. So, I mean, it's hard to say whether this is high or low without context, but the point is that the exposure seems manageable even in such a severe scenario. Okay, so let me move on to the last part of the paper where we examine how banks are adjusting lending to the riskiest borrowers. This is related to some of the questions that I got earlier. So what I'm plotting here is the bank's proportion of lending to high exposure versus medium exposure versus low exposure loans. And the vertical line indicates the Paris Agreement in 2015, Q4. And you can see that after the Paris Agreement on the left-hand side, you can see that the bank's proportion of lending to low exposure loans, which are in green line, goes up substantially, while their proportion of loans to high exposure loans fall. And the way we categorize the loans into high, medium, low exposure loans was based on the Jorgensen model's estimate. And on the right-hand side, we used the NGFS estimates to categorize the loans. And again, you can see that the banks lending to the low exposure loans went up substantially, while their proportion of lending to the high exposure loans fell, which is in blue line. So this suggests that after the Paris Agreement, banks moved their credit exposure from the riskiest to the least risky industries. So this is some evidence showing that banks are actually adjusting their lending. And we tested this idea formally by running regression. We regressed either the proportion of lending to the riskiest industries or the price of the loans on the interaction of post and exposure variable, where the post is a dummy variable which takes a value of 1 if it was after the Paris Agreement or the Net Zero Banking Alliance Agreement signing. And exposure is the exposure under stress the quarter before the Paris Agreement. And we expect to see negative betas for the quantity of the loans and positive for the price of the loans if banks are pricing the climate risk and managing the risk. And here is the regression result when the outcome variable is the share of lending to the riskiest industries. And you can see that for some of the models, some of the policies, you can see that the coefficients are negative and significant. So this suggests that the banks are reallocating their credit exposure based on the riskiness of the industries. And this is looking at the pricing. So we regress the yield spread on the full interaction of the post and treated. And here you can see that for some policies, the interest rate spread is positive. This means that banks are charging higher interest rate to the loans that are considered riskier after the Paris Agreement or the signing of the Net Zero Alliance in the last 3 rows. And in terms of the magnitude, this is about 20 basis points. And you can see, the post signing of the net zero alliance seems to have more significant effects on the pricing of the loans. Okay, and in the very last part of our paper, we looked at the relationship between the banks and borrowers. And we wanted to see whether that changed after the bank's signing of the Net Zero Alliance. And what we are plotting here on the left-hand side is based on the Jorgensen models to categorize the risky versus less risky loans. And you can see that the brown loans became more likely to switch to non-signatory banks. So that's what I'm plotting here. This is the ratio of switch to non-signatory divided by switches from non-signatory. And the higher number means that they became more likely to deal with the non-signatory banks. And on the other hand, the green borrowers became more likely to switch to signatory banks. So what this is suggesting is that after the bank signing of the Net Zero Alliance, brown borrowers switched to non-signatory banks versus green borrowers switched to the signatory banks. And on the right-hand side, we use the NGFS model to categorize the brown versus green loans. And here we also see that the bank-borrower relationships are changing after the signing. And the result is different based on whether the borrowers were brown or green. So the takeaway here is that the relationship also seems to be changing. And we also looked at our exposure measure in relation to the emission funding. So analysis so far were all based on the general equilibrium estimates, and you might have been wondering how much of our measure is explained by the borrower's carbon emissions, which is a commonly used backward-looking measure. And we also asked this question, are policy effects stronger for higher emitting firms? And this is the R squared of the regressing our exposure measure on the bank level emissions. And 1, 2, 3, 4 are different scenarios, and each row is different model. So the first row is based on the Jorgensen model, and for the $25 tax 1% growth rate exposure measure, 57% of the variation in our measure is explained by the carbon emissions. So this is not surprising. It's not surprising to find that they are highly correlated, but you can also see that only 60% is explained by carbon emissions and 40% is not. And in some cases, like this case, based on the Golder and Hofstede measure, we find that only 25% of the variation of our exposure measure is explained by emissions. And we think that this is because our measure is incorporating the forward-looking component, and also we consider our measure based on the general equilibrium models can capture both direct and indirect effects of the carbon policies. And our policy effects stronger for higher emitting firms. To answer this question, we regress the exposure measure on the interaction of the policy and the emissions. And we hypothesize that the beta should be positive because stricter policies are likely to be to have stronger effects for higher emitting banks. And that's what we are finding here. We find that the coefficients on the interaction terms are positive and significant, which means that higher emitting banks are more exposed to stricter policies. And these results are robust to using fixed effects and also emission intensity, where the intensity is obtained by dividing the emission amounts by the company's sales revenue. And within industry heterogeneity in emissions, we were wondering whether the firm level, so the idea is that within the same industry, firms can have varying emissions, and that could be a concern if a bank is having a specific sorting where they make loans to low emitting industry, but they actually lend to high emitting firms within that industry. So to address this concern, for each bank time industry, we identified the highest and the lowest emitting next 3-digit sectors. And we computed the lending made to the highest divided by the lending made to the lowest emitting sectors. And we regressed this ratio on the bank fixed effects and the industry fixed effects. So if a bank is having a certain sorting within the same industry based on the emission, we're going to see a significant coefficient on either bank fixed effect or industry fixed effects. And what you're seeing on the left-hand side is based on the Jorgensen model exposure measure, and you can see that the coefficient on the bank fixed effect is never significantly different from 0. This suggests that banks are not having a certain sorting within the industry based on the emissions. And that's similar based on the NGFS model. On the right-hand side, you can also see that the coefficients are never significantly different from 0. So that does not seem to be a concern. And to conclude, in this paper, we develop a new measure of banks' exposure to transition risk, building on general equilibrium model estimates. And we find that the estimated exposures are generally modest, and they are no higher than 16% in a very severe scenario relative to their current loan balances. And banks' exposure to the riskiest industries appear to be decreasing over time, although they are quite persistent. And lastly, we find some evidence that banks decrease lending and increase their loan spreads for highly exposed industries in recent time periods. So for the remaining time, I'd be happy to answer any questions. And thank you, everyone.
Awesome. Thank you so much, Hyeyoon. Really interesting presentation. There's a lot of comments. I think a lot of people are interested in this topic. So also thanks for everyone for their Q&A questions. So like Hyeyoon noted, we have about 10 minutes or so of time for Q&A. So if you'd like to post them in the Q&A response box, we will try and get through as many of those as we can right now. You're also welcome to raise your hand on Zoom. If you hit that button and you want to speak live, we can try and get you on, so I'll try and moderate that. But why don't we just start with some of these Q&A questions, Hyeyoon. So I'll read them out just so people can hear them, and then you can answer them. So the first one says, do you also have estimates on losses in bank equity capital across these different transition scenarios? Since banks are highly leveraged, even milder loan losses in some scenarios might imply more severe equity losses.
Yes, so in the paper, we computed all of these based on the leverage, as of bank's equity capital. And as you suspect, the more highly levered banks are going to have higher exposure. So that's completely consistent with your question.
Okay, great. Next question, what type of optimization is in the models? Static, dynamic, information limits? Do you have any sort of insights on what they're doing in those GE models?
Yes, so I think I actually have a model schematic, and you can see that it's quite complicated. But the forward-looking feature is the most important feature I think we are using, and that's by linking linking the price of assets to the discounted value of future capital services. So the model is dynamic, has a dynamic nature, but there is no surprise component, so we're not able to compute estimates like what if there is a carbon tax stronger than expected implemented, or what if they get implemented earlier than expected. For those questions, we are unfortunately not able to answer.
Right. Next one, with respect to the NZBA finding, is it fair to say that banks that are in NZBA are enhancing their position for profitability, even if the risk from transition on this one measure of a carbon tax are pretty minimal?
This is a great question. So this is great question, but obviously very challenging to answer whether they are sacrificing the profitability to make their loans greener. And there must be some component, some benefits coming from making their brand greener, and other benefits as well. So I think this is an important question, but we don't have a good answer. But we do see that the banks that signed the Net Zero Banking Alliance is reallocating their credit from riskies to less risky loans. But it's hard to say whether they are enhancing their position for profitability or something else. I think it's a great question, but I'm not sure what the answer is.
Okay. So one more here in the Q&A. It says, was any consideration given with respect to the scenario proposed by U.S. Federal Reserve Board for the largest banks?
Yes and no. So the NGFS, we are considering the NGFS scenario, and that the NGFS scenarios are the ones that the Fed use for the scenario analysis. However, the specific calibration can vary across specific set of assumptions. And I don't think we are using the exact same parameters and assumptions, but in the sense that we are also using the NGFS scenario, and the Fed scenario analysis was also considering the NGFS scenario. In that sense, we are taking that into account.
Great. One more Q&A here. It says, don't we have a strong prior that carbon taxes are purely redistributive, shifting the composition of output but not changing overall output and profitability? In that case, the average bank would experience no drop in creditworthiness, with brown sectors becoming less profitable and green ones becoming more profitable.
Yeah, that could very well be the case. And in that case, as you mentioned, we're going to find bank exposure even lower than what we are having. So the whole takeaway of our analysis is that the bank's exposure seems manageable. So in that sense, I agree with you.
So we still have a few more minutes. If anyone else has any questions, they want to send them in the Q&A or the chat. Maybe this gives me a chance to ask a couple of questions I had. So you sort of mentioned already that you're sort of the response to like surprises is limited based on the GE models you have. I'm wondering if you've had, just based on my personal interest, any thoughts or considerations about how you might deal with the uncertainty of these pathways, right? There's sort of a lot of potential outcomes that could happen that are either in or not in these scenarios. Do you guys have some way, or have you thought at all about how that might be relevant, whether it's like the spread and pathway outcomes or something that might matter here for banks?
I personally think that it can matter considerably. And in this paper, we are looking at the credit portfolio exposure. So we are really focusing on the credit risk.
Mhm.
But in my other paper, I'm considering the market risk as well. And I think the uncertainty can play a big role because we are finding that the surprise component can affect the pricing and valuation of the bank substantially as well. But I'm not sure how to consider in this context without a solid model. Maybe your models are useful to think about these questions.
Yeah, I think it's a empirically an interesting question. I'm not sure either, but something I think interesting. So maybe one more quick question, and then we'll have a couple more in the Q&A.
Sure.
Um, I guess I was sort of surprised to see that there were sort of estimations that you did where some of the projections mattered and some did not. I guess I anticipated that the magnitudes would vary, but if it mattered, it would matter across all projections. Is the right way to interpret that perhaps banks are sort of viewing some of these projections as sort of closer to what they expect while others are not? Or do you have like an interpretation for why some of these might be relevant and some of them might not in some of the estimation?
That's a great question. One thing we've been trying to do is whether banks are, yeah, we obviously there is no good measure of banks' view, but what we have is the bank's assessment of probability of default for each borrower. So if two banks are lending to the same firm and if they are assessing the PD differently, somehow that can be useful to think about your question. Um, But yeah, I mean, it'd be interesting to see that.
Okay. So if you have time, it looks like we've got basically 3 questions left. We could just end with those. Does that work for you?
Yes, of course.
Okay, so one of them here is in the chat. It says, as a follow-up to the earlier question on profitability, it looks like NZBA banks are just trading brown for green, but the earlier findings in your presentation, there isn't much risk from a carbon tax, but that the greater the exposure correlated to lower returns. That is why I think the effect of a transitioning bank is not on risk as much as profitability. And I'd be happy to follow up on that. So more of a comment. So maybe we can follow up on that unless you have any thoughts.
I mean, yeah, I think that's great comment. I think more study is necessary. You know that the NZBA happened very recently, so we don't have a good long time series to analyze this. So it would be interesting to see how it evolves in the future.
Okay. So a couple more quick questions. Have you thought about how the findings here would be relevant to setting a higher capital requirement for carbon loans, for high carbon loans?
Um, this is an important question, but I think we need more study to think about the higher capital requirement for high carbon loans because especially given that there are so many capital requirements for banks and we have to think about how it's going to make which banks binding and what's like the cost and benefit of it. So I think we need to learn. I think we need more research.
Okay. And then quickly, do you have similar figures with regards to like exposure to physical risks? It's sort of the 2 things that could matter. So do you have any insight onto that?
Physical risk is not considered in the paper, but obviously very important. I would not be surprised to see that there is correlation between the transition risk and the physical risk. So it would be important consideration, but in this paper, we were not able to do anything on the physical risk dimension.
Okay. And last question here, expecting your discussion to focus on the surprise component since the credit risk, as conventionally understood, being all about surprises, have you considered rebuilding your market measures based on EDFs rather than equity prices?
So that's pretty much my other paper. So my other paper is not exactly, but it's exactly looking at the bank's equity prices, how they respond after the surprises. So I would invite you to take a look at my other paper. It's called C-Risk,
Awesome.
Measuring the Climate Risk of Financial System.
Perfect. That's a great way to sort of wrap it up. I think you've got a number of really interesting projects, and I think this is one of them. So thank you so much, Hyeyoon, for that. Um, just as a reminder to everyone, before we close up here, first of all, thanks so much for Hyeyoon. Wonderful presentation. I think a ton of interest and questions on this, so feel free to reach out with more questions. Also, as a reminder for those sort of interested in the e-access webinars we've been doing, our next one is going to take place on April 29th, when Olivier Darmouni from Columbia will talk about his research on brown capital reallocation. Again, another sort of very relevant and interesting question. In the chat, I believe, for anyone to see, the link has been placed for that for more information. I think Hyeyoon is going to try and make maybe her slides available or other information, and I'm sure would be happy to answer questions. Really wonderful participation. Thank you so much, everyone. And we look forward to seeing you next time.
Thank
Thank
you,
you, everyone. Thanks, Hyeyoon.
Mike, and thanks everyone. Bye.